Hello, everybody. It's Professor Hassey. It's Business 330, week number 3. It's Friday, April 9th, 2021. The hour is about 11:30 in the morning, and I'm speaking live and in color from Finance Central here in Claremont, California. I apologize for class this Wednesday, feeling under the weather, and I was feeling even under the weather yesterday. And so here's my video for this week to explain a few things for our class. Remember, we have an assignment number 1 due this Sunday at midnight to Blackboard. Please post your work file by that time, and I'll go over that assignment in just a minute. We're also talking about the time value of money, and we'll talk more about this in our class next Wednesday and in our Wednesday class in our week number 4 work. The time value of money, what is present value, future value. There's some excellent problems to practice on in Chapter 5, and they are included in Blackboard. In assignment number 1 this week, we're asked to do a little bit of you are asked to select one company from your portfolio and do some work on it. Use the internet to find information and to do some calculations. Part of our work last week was we looked at the financials of a company. Remember this work here in week number 2. We looked at their balance sheet. We looked at their income statement. We looked at their statement of cash flow. And then we looked at the statement analysis, financial statement analysis, which is Chapter 4, specifically page 105 of your textbook. And I ask you to perhaps do some calculations for 2020 with key financial analytical ratios and information of these financials. So I want to go over these because you're asked to do these also this week in assignment number 1. So you find the financial statements, and where do you find financial statements for a company? You can go to Yahoo Finance and locate them there. You can go to the company's website under Investor Relations. You can go to Hoover's Online, the online database through our library. There's a lot of different ways to get the financials, and that's your job in this assignment, is to go and find the financial data for the most current year for a company that you select from your portfolio. For example, the liquidity ratio or the current ratio is a relationship of current assets divided by current liabilities. So if I go to my financial statements for 2020, I see my current assets are $2,680,000. My current liabilities are $1,039,000. So if I go to my formulas there, I can just drag over that thing, and there's my liquidity ratio of 2.58 for 2020. That's compared to the industry average of 1.25 for this company that we looked at in week 2. That's rather high, and that goes back to our discussions on week 2 about their high accounts receivable and inventory position. Another key ratio for companies is what percent of the company is financed by the borrowing of money, be it short-term or long-term debt. And that's the balance sheet, which is the relationship of total liabilities, $1,539,000 as a percentage of their total assets. So if we do that for 2020, it's about 44%. Excuse me. Naturally, it went down quite a bit from 2019, because remember, we discussed this in week 2. The company issued stock and almost paid off $900,000 of debt. So that dramatically reduced their debt position in the company, and that's compared to the industry average in this company's industry of 60%, doing better there. The profit margin on sales is the relationship of the net income of the company. In the 2020, it was $253,584 as a percentage of their total revenue, in this case, sales. So we take that relationship here. Their profit margin is 3.6%, a lot better from 2019 when they lost money, but still quite a bit lower than the industry average in their industry for the profit margin on sales. Another key analytical number is the return on total assets. That's the net income as a percentage of their total asset base of the company. $253,584 divided by the total assets, $3.5 million. we get a 7.21% return on total assets. This is for every dollar invested in assets, what kind of profit is being generated by this company. Again, they're below the industry average of 9%. The price earnings ratio is another example of market value or relationship. But before we get that, we need to calculate the earnings per share. The earnings per share is a relationship of net income to number of shares of stock outstanding. At the end of 2020, this company had 250,000 shares of stock owned by the market, their shareholders. What is that relationship? 253,584 net income divided by shares outstanding, and we get their earnings per share, approximately a little bit over $1. For every share of stock outstanding, the relationship there is $1.01, earnings per share. That doesn't mean each shareholder gets $1.01. Remember, that's our dividend. But this gives another way of showing net income. Instead of saying, oh, we made $253,584 in 2020, another way of saying is we made $1.01 a share, still below industry average. Well, once we know that earnings per share, then we can calculate the price earnings ratio. And the price earnings ratio is the earnings per share in regards to the stock price. What relationship is the common stock price in the market at the end of that fiscal year in relationship to the earnings per share? So it's common stock price divided by the earnings per share. So in that case, the price of stock is $12.17. We divide that by our earnings per share, and we get a 12.05 times. In other words, the earnings in the market in relationship to the stock price is 12 times greater than the earnings per share, 12 times greater. Naturally, the higher the PE rate earnings ratio means the more overvalued the company is. A higher stock price in relationship to low earnings means that the market thinks the stock is a lot higher than it really should be. In the case of the industry average, or about close, the industry average is 10 times greater. Again, this is another valuable investment tool for many investors, is what is the relationship of stock price to the earnings per share. The lower the PE ratio, the more undervalued the stock is. The higher the PE ratio, the more overvalued a stock price is. Undervalued means maybe it's a time to buy. Overvalued means hang on to your shorts or sell the stock. It's overvalued. It's eventually going to drop in price as soon as the market figures out that it's overvalued. Now, in the case of like Tesla and those type of companies where the stock price and the PE ratio are extraordinarily high, the market says we're willing to live with that, and there's not too much selling of that stock. But it depends on the company and depends on the industry they are in. One last thing I want to talk over is the average collection period. How long does it take us to collect our receivables? And what that is, it's the accounts receivable balance in relationship to our average daily sales. All right. So in 2019, we had an accounts receivable balance of $632,160. All right. I believe it was. Let's double check that. Yeah, there it is right there. 632,160. And we had a average daily sales of total sales divided by 365 days in a year. So for 2020, our average collection period then would be our accounts receivable, which is $878,000. Remember, we're doing formulas now, so we put these in parentheses. 878,000. We need to put in commas, divided by the average sales per day. Well, what was our sales per day in 2020? 7,035,600. We go back to that. We take 7,035,600 and divided by 365 days. And we get Gotta figure out one more parenthesis, sorry. Put in another parenthesis, there we go. And our average collection period is there, 45.55. And let's fix this in 2019. Our total sales were not 7,035,600. That was 220. That was 2020. Our sales were 5,834,400. So let's check the correct 2019. 5,834,400, and there's our correct amount. So in 2019, our average collection period, and let's round to the nearest number there. There we go. So in about 40 days in 2019 and almost 46 days to collect our receivables in 2020. That's not good, and that's one of the reasons why we have a high current ratio. It's taking us a month and a half to collect our receivables. And that's getting worse. Look at the industry average, 28 days. So again, this is the accounts receivable divided by the average sales per day. And you take your sales figure, revenue, divided by the number of days in the year. You get that average sales per day, and how many days does it take to cover the receivable balance? That's our average collection period. So overall, and as we discussed in week number 2, this company had some fairly decent financial information or numbers, but at the same time, they have still they issued stock to pay back debt, which is old capital instead of reinvesting into new assets. They have a very high liquidity position, which is a result of high inventory and high receivables. Their returns on their profit margins and returns on assets are still favorable, but compared to the industry and their competitors, not as good. And they need to work on their collection of receivables. So that's a financial statement analysis to complete our work in week number 2. And in our assignment, you're asked to find some of this information. And to do that, let's take a look at our assignment number 3, or number 1, excuse me. So this is our first assignment for in this week number 3. This is our assignments, remember, lead up to examinations and lead up to papers. They are only worth 10 percentage points apiece. So it's not as much weight assigned to these, but it's good practice, and this gets you prepared for doing your case paper later on down the line. It gets you prepared for your final examination. These are all key topics, key definitions, key calculations that you need to do to be successful in this class. Again, you download it from the assignment file in Blackboard. I give you a PDF and a Word doc version. They're both the same. You do your work in those file folders, or you can do it in your own file folder, and then you post it and upload it to Blackboard. So it's pretty self-explanatory, except towards the end, and I'll go over that. Just to short answer problems. I even give you the chapters that they come out of our text, and so you can relate that also to our work and our review in Blackboard. Some multiple choice questions. Read those questions carefully. They're designed not to be short and easy. They're designed to make you think. So make sure you read those questions carefully, and I give the points assigned to each problem. Here's a good one. Again, read this carefully. Here we're doing a financial analysis, financial interpretation, and I'm not giving you the financial statements of a company. You got to kind of put those together yourself. Based on this information, I want you to find 3 numbers. Their earnings before interest and taxes, sometimes called EBIT, sometimes called operating profit or loss. I want you to find number 2, the net income of this company. And number 3, cash flow from operations. Cash flow from operations. Those 3 numbers I need you to find based on this information. $500,000 of sales, $10,000 in cash dividends, $300,000 of cost of goods sold, $20,000 in administrative expenses, $20,000 in depreciation expense, $40,000 in interest expense, $10,000 purchase of productive equipment, no changes in working capital, and a tax rate of 35%. Put those into the format of the financial statements that we've discussed, more preferably the income statement, and determine those three things: earnings before interest and taxes, net income, and cash flow from operations. It's requiring you to think, put it together. It's like putting together a puzzle. You'll be fine. And then we get to question number 9. Define a profit and loss statement, an income statement. What does it tell you about a firm? Who uses it? And why is it important? Don't forget to answer all those areas of this question. A lot of times students only get through one part of it and then they forget about why is it important, and you get points knocked off. I want you to select one company from your portfolio to use in your definition of the income statement. In other words, look up the income statement of your company and answer those questions. What does it tell you about the company you selected? Who uses that information? And why is it important? From one example of your company. Now, you don't have to show me that example. You don't have to download the income statement and show it to me. You should download it for yourself to look at it, but you don't need to post the income statement to this problem. I already have that information, but I want you to select a company and tell me those things based on your interpretation of the income statement for your company. In question 10, all right, I want you to use that same company and I want you to find their earnings per share. What is it? What does it indicate to a firm and an investor? Using that same company, I want you to look up and find for me the earnings per shares for the last 3 calendar or fiscal years for your company. So this is April 2021. So probably it's 2020, 2019, and 2018. What is the earnings per share for those 3 fiscal years? And explain to me, have they gone up? Have they gone down? Maybe a little percentage analysis over the last 3 years. That would be impressive. Your job is to go into the internet and find the earnings per share for the last 3 years, or calculate yourself if you so desire. But there are a variety of resources, and I've already mentioned them earlier. Yahoo Finance, the company's website, Hoover Online, that you can get those numbers directly. And then finally, question 11. Again, using the same company, go back 2 fiscal years. That's probably 2019 and 2020. And find me the current ratio for both years, please. The debt ratio, the profit margin, and the return on total assets. A brief comment on each and what they mean or represent to the company. Not their deltas or their changes, what that means, but what does the current ratio tell you about your company that you selected? What is the debt ratio? What is the profit margin? What does the return on total assets tell you about your company? So you select one company and that entitles you to answer the questions 9, 10, and 11. Notice there's no portfolio work this week in this assignment. It's strictly financial analysis and the introduction or definition of finance. That is your assignment number 1, due Sunday evening. Also, make sure you review Chapter 5 of the text, our Week 3 file folder in Blackboard for the week of April 5 through April 11. The definition and the information of the time value of money. Here's a brief video explaining it. You can download that. Here's our PowerPoint for the chapter, and here's my definitions of the key points of the time value of money. Here are some review problems. We'll be going over these review problems next week in our Wednesday volunteer class session. If you want to try and look at those, feel free. Here's some excellent videos about the definitions of the time value of money that it would probably be very good for you to go over. In other words, how does the value of money compare to today compared to the future? Money has a valuation. It increases value over time because of interest, compounding, return. It also depreciates over time because of inflation. Money is more valuable today if it just sits there in an account with no interest compared to that same money in a year from now. It's less now. Why? Because of inflation over time deflates it. So that's an important concept, understanding the value of money in the present and value of money today in the future, and also the future or present value of cash flows. How do people decide about investment needs? They project out what that investment is going to return into the future, and they present value it or discount it back to today's dollars at a current interest rate, usually the cost of money. And that gives you the present value of that money today, taking into account that discount rate. And we'll talk all about this next Wednesday and next week in our class and look at examples from stocks and bonds and investments and how that applies to the time value of money. A very important concept in the study of finance. So take a look at these videos, make sure you're up to speed on that, and we'll review all this in next Wednesday's class. So to conclude our little video for this week number 3 and make up for our class missed on Wednesday, again, I apologize. All of you have now completed your portfolios and set them up. All of you now, or most of you, have had your student interviews, and those grades are posted. If you have put in adjustments to your portfolio or have yet to talk with me, those grades are still incomplete, and I'll be posting those and fixing them up over this weekend. So make sure that we're all on the same page as far as where our work is concerned now. You have some graded work due this Sunday. It's due on a Sunday at midnight on chapters 1 through 4, and we've just gone over that. Next week, we talk about bonds and stocks, ways of financing companies, the borrowing of money in the bond or credit markets, and the issuing of equity in the stock markets. We will also have a discussion post number 2, some work to do next week, which is some more portfolio work of your portfolios. That's our topic and our graded assessment for next week. But assignment number 1 is your task at hand this week. If any of you have any questions or concerns about that, please feel free to let me know over the weekend. And I look forward to seeing you all on video next Monday to introduce week number 4, and then in our voluntary class next Wednesday evening at 6 o'clock. So thanks again, everybody. I hope this video helped you and clarify some things. Have a great weekend. Be safe. And until week 4, adios.